Where do you see Nifty going from here by, let's say, end of 2030?
If you go by past averages, you should not be surprised if in the 5 years, let's say it can.
Which sectors are likely to grow faster than possibly Nifty?
Either their portfolio is beating the lights out of the market or they are nowhere near the market, they are down in the dumps. Every portfolio is a list of stocks, but any and every list of stocks that you come by cannot be called a portfolio.
Hi friends, a lot of us are interested in building stock portfolio for, let's say, 2030. But the biggest challenge that personally I find is that if you look at both the exchanges, we have more than 7,500 plus listed companies. There is more confusion than clarity. And to nail down all of this confusion, today on Wealth Couch, I have invited Mr. Aashish Somaiyaa, who is the CEO of WhiteOak Capital Asset Management. And Mr. Aashish has more than 20 plus years of industry experience in mutual funds. He has built AMCs from grounds up. It's going to be an extremely knowledgeable conversation, I'm hoping. And I'm sure you all are going to enjoy this one. Please do not skip. Listen to Aashish's wisdom, and I'm sure learning will come to you immediately. With that, Aashish ji, thank you so much. I know it's Sunday morning and we are shooting it on a Sunday morning. So I really appreciate you giving us some time today.
Thank you, Rahul. Thanks for inviting me.
Aashish ji, I have a lot of questions, and as a student here, I would like to learn from you. And I want to start with, there's a lot of noise right now in the market, Indian equity market. One thing that I wanted to get out of the way first is, where do you see Nifty going from here by, let's say, end of 2030? So we still have 5 years to go. What are the growth triggers in Nifty that you personally see?
So, Rahul, 2-3 things. I've always been in the stock market, always been in mutual funds, right? And I think that, people like me and people who invest in India's stock market, or people who invest in India's, say, equity mutual funds, I think all of these people are, lucky people. The reason is because, the best of businessmen, the best of investors, and the best of professionals, whoever you may be, however good you may be, the fact is that the best of people also need a tailwind, right? However good you may be, but if you are perpetually faced with headwinds, then, your progress will not be as much. But all of us have been blessed to be in a country where we have seen tailwinds for the better part of, our existence in the stock market. So keeping that in mind, I think there's no reason to be pessimistic or bearish at all. And in fact, I have always believed that equities are for optimists, right? So keeping that in mind, and also let's keep in mind one more thing before I answer your question, which is that if you take the last, say, a lot of times all these Nifty and Sensex charts, they start from 1979 and all. Personally, I don't think you should start from there. You should always start the discussion from 1992, because before 1992, in most sectors, there was no private sector allowed. And obviously, if private sector was not allowed, then where is the question of foreigners, right? So only after 1992, a lot of sectors opened up for private investment. And that's when a lot of businesses started getting listed in the stock market, and they opened up for foreign investment also. So if you start from, say, 92, 93 till now, 12.5% compounded is our nominal GDP growth. The real GDP growth is between 6 to 7% and inflation of 5-6%. So you will find that on average, nominal GDP has grown about 12 to 13% compounded. The beauty is that even the earnings of Sensex companies have also compounded about 12 to 13%. And Sensex itself has compounded about 12 to 13%, plus you can add 1 or 2% of dividend, right? So this is the history of last 32 years. The beauty is that while long compounding is 14%, practically every year from its high point, once or sometimes twice, the market has fallen 15-20%. So now see this conundrum. The long range compounding, if you stay put, the long range compounding itself is about 13-14%. But why it becomes difficult to stay put is because literally every year from its high point to its low point, once the market itself falls about 14-15%, sometimes even 20% or even more, right? So the problem is not what type of return we will make in future and where the index will go. The problem is, will people be able to
stay put?
Stay put. So these couple of things I think you should keep in mind. Now coming to the more important question, like you said that what is the vision, what we think will happen by 2030. So today if you see the market is not very cheap, not very expensive. The starting points are important, right? Like if we try to forecast that where the market can go in the next 5 years. If the market was, let's say if you asked me this in 2024, then in hindsight I should have known, and I mean we did have a sense that in 2024, 26,000 Nifty was considered to be expensive. Now we are almost through say 7-8 months of 2025 and Nifty is still maybe 1500 points lower than where it was a year back. The beauty of the market is that it has fallen 8% or maybe 10%, and in 1 year the earnings also grows by 10-12%. So for 1 year if the market does nothing, it automatically becomes cheap by about 50-odd%. So compared to last year, right now where we are having this discussion, it is a relatively better starting point to have this discussion.
Right.
Because where it can go in 2030, the starting point is important. So that's out of the way. It's not very expensive, it's not very cheap, we are reasonable, right? Now, if you go by past averages, you should not be surprised if in the 5 years, the Nifty say more or less in the next 5 years or 6 years, more or less, let's say it can double. That has been the run rate.
Right. 14%, around 14-15%.
Yeah. So if it is 14%, it should double in just over 5 years.
Right.
If it is 12%, it should double in 6 years.
Right.
So even if by 2031, the Nifty doubles, then we are all in a good place because that's a very, very handsome return. And I won't be surprised if it actually happens. Right? And I'm not saying anything outlandish. There are people who are sometimes cynical, skeptical, pessimistic, but I'm not saying anything outlandish. This is the rate at which it has. And that is why I clarified that the starting point is important. And today we have a reasonable starting point. We don't have a very expensive starting point. If it was a very, very cheap starting point, I would not have said 2031. I would have said 2028 or 2029. But my sense is that we are at a reasonable starting point and we have very good growth prospects, right? If you see domestic conditions are quite strong. It's the external environment, whether it is tariffs, whether it is geopolitics, whether it is the US economy itself. I think these are the things which are bringing about uncertainty. But as far as India's domestic conditions are concerned, they are actually quite strong and they have been improving for the last some time. So no reason not to be positive. I've given you a very long answer, but between 2030 and 2031, at some point in time, you will see that the index should double from here. And then if you have a good fund manager, then they should be able to do better because they should be adding some alpha over what the Nifty can do.
Yeah, I think just would like to add one point that I think typically what happens is when we look at the 5 years of time frame, we get hung up on the fact that is it growing every year at 15%? And that's where I think reality needs to be checked, that it's not about just 1 year. I think it's the cumulative growth. We're talking about 14-13%.
One thing about stock market which everybody should make peace with and accept it is that very important point you said, that when somebody says 14-15% compounded, it's a very important point you made, that people expect that it will be 14 in 5 years. The point is that two words are very important about stock market returns. One is they are non-linear, and second is that they'll be lumpy.
Right.
So if you are talking about a 5-year period, there'll be any period of couple of years when you will get fabulous returns, and then couple of years when the market does nothing, and then maybe even a year where it goes down horribly, right? So equity returns are always non-linear and lumpy. Second is related to our previous conversation, that if you're, in good times, you may double money in 3-4 years. And in bad times, it might take 7-8 years. Right. So so that 14% is an average. And 5 years to double your money is also an average. In good times, it can be faster. In bad times, it can take
slightly more. Yeah. Great. I mean, thank you so much for that vision. And I think, as you rightly said, we really got to be optimistic about Indian economy, Indian stock market. And for an equity investor, that is extremely important. But I think I just want to also check with you, Aashish, what is your thinking behind sectors, right? So let's say if I were to pick 4 to 5 stocks or maybe 10 stocks, right? For 2030 portfolio, and I'm happy to stay put, right? As you rightly said, which sectors in your view are likely to grow faster than possibly Nifty?
So I'll make one distinction here. I will definitely, with all respect, I'll answer your question, but I'll also clarify one thing, that when it comes to managing public money, when it comes to managing our mutual funds, we don't go by sector really. See, we think that our dharma is to beat the benchmark. So take an example. If there is a flexi cap fund, the least an investor can do is buy BSE 500 index, right? So the least that an investor can do is buy the index. So if an investor is choosing to give money to me, then obviously the least I should try to do is to beat the index.
Yeah.
Correct? So when we manage money, we don't think in terms of sectors. We are very, very benchmark aware. We are not benchmark agnostic, and we don't copy the benchmark.
Sure.
But we are benchmark aware. Why? Because our competition is with the benchmark. We have to do better than the benchmark. So we're always mindful that what is the composition of the benchmark and how is the benchmark behaving. So when we manage our portfolios, we make our portfolio relative to the benchmark. And benchmark has good companies, bad companies, PSU companies, private companies, domestic, export, defense, defensive, cyclical, large, mid, small. All types of, and all the sectors, they are represented in the benchmark. So when we manage our portfolio, we try to balance our portfolio and have some tethering of our portfolio with the benchmark. We don't make a portfolio which is completely disconnected from the benchmark. If you make a portfolio which is totally, like you said, few sectors, 10 stocks. Now what will happen is, in the kind of portfolio which you are talking, which I will answer for sure, but the kind of portfolio you are talking, you might find at times that the market is going up, but your portfolio is where it is.
Sure.
You might find at times that your portfolio is absolutely blowing the lights out when the market is doing nothing. So what will happen is that such a portfolio will not have any tethering or any anchoring to the broader market itself.
Right.
Whereas what we are trying to do is trying to beat the index consistently.
Yeah.
So our portfolio has some relative tethering to the benchmark, and in every sector we are trying to buy stocks which will do better than the stocks in the benchmark. Right? So that is our thought process. Now coming to your question, of course, that if you leave aside our preponderance or our preoccupation with beating the benchmark, if you leave that aside, and if you say no, in isolation, just let's look at which sectors, So see, there are a few drivers. Why are we bullish, or why is everybody talking about India's potential growth? There are a few drivers for it. Major driver, right? See, everybody talks about GDP growth. There are two things which are important. One is that, of course, we are going to become one of the largest economies in the world. We are already, but we are going to climb the league tables and probably become third largest economy in the world. And already our GDP is, say, more like 4 trillion, and it is expected to grow. Correct? The beauty is not just the 4 trillion, Rahul. The beauty is that there are not many which grow 7% at 4 trillion. That is the key part, right? Having 4 trillion, big economy. But returns are always made on growth.
Right.
If your company, my company, any country, if the annual output stagnates, if the annual output remains what it is, then the value of the business will not grow. Same way at a country level, it's important to have 4 trillion GDP because it determines size of output, and size of output determines how much it takes to keep that output going.
Sure.
But when you're already 4 trillion output and you grow 7%, means your incremental output is nearly 300 billion a year. Till few years back, our neighbor's GDP total was 300 billion. Right? So what is our neighbor's GDP? That much we are adding every year, literally.
Right.
Correct? Now the point is that when you are growing at 7% on 4 trillion, for a country, growth is always some metric of population and productivity of the population. Correct? So it's drawn on population and productivity. The biggest determinant of productivity is the age of the people. Of course, there will be infrastructure and technology and education, and we have challenges with many of those. But the reality is that productivity of a population is determined by the age.
Right.
So from this discussion, you will realize what are the drivers of, you said sectors. So what are the drivers of this growth will tell you what are the sectors to really look at, right? So first is that if you expect our country's GDP to grow, and obviously, thankfully, the population is not growing as fast as GDP. So the per capita is rising. So when per capita is rising, you expect India to go from being a lower middle class country to a middle class country in the next few years. And when a lower middle class country goes middle class, it's not like 140 crore people become middle class. What actually happens is that there will be a few thousand people who become billionaires. There'll be a few lakh people who become millionaires and crorepati's, right? And there'll be a huge bunch of people who will become lakpati, correct? So everything to do with discretionary consumption, everything to do with higher value consumption, apparels, footwear, eating out, retailing, travel, tourism, hotels, these kind of things start to get a lot of traction. So everything to do with discretionary consumption is one. Second is that when people come out of poverty, their first priority is to plan for the future. So saving, investing, wealth management. So typically the banking industry, people get stuck with banks and NBFCs. But if you ask me, capital markets, asset management, wealth management, insurance, these are the big drivers.
Right.
And the last thing which I'll leave for you to think about is, everything to do with manufacturing, because we will be the world's biggest consumer force and the world's biggest labor force. So you will find India becoming a more and more salient manufacturing base. Right. So these are just, the highlights that one should think of.
And what about some sectors that people keep talking about, be it power sector, right? 2030, I know you're smiling, be it power sector, right? Be it, for example, EMS,
yes,
right? Be it data center theme. There are these sectors that definitely are showing huge growth. I mean, for example, I don't know, data center theme, if you look at it, right? We are looking at 30 to 35% of CAGR growth in terms of the capacity, right? So my point was, of course, we are not going to build a portfolio only with, let's say, 5 or 10 stocks.
Of course.
In a portfolio, you would have it, I don't know, banking stocks, FMCG stocks, etc., which are evergreen.
Absolutely.
But typically, as investors, we also look at, including or allocating a part of the portfolio towards high growth industries. So I know consumer discretionary spending is the one you talked about, but is there any other sector that out of these that you are really...
Yeah. So, of course, I mentioned a broad thing, like say, for example, I mentioned about manufacturing.
Sure.
Now, clearly, manufacturing has multiple legs to it, right? Like one of the most darling things of the market has been defense. So manufacturing related to defense and defense equipment, right? But I'll tell you before answering your question, one thing, Rahul, is that we also have to keep an overall market perspective or market wisdom in mind, which is that when anything becomes a buzzword, then one has to be very, very careful, right? So some of the things, like you identified the right themes, but some of these things like green energy, electric vehicles, these have become kind of buzzwords. Like defense also became a buzzword in the last couple of years. I personally always see defense as a subsegment of manufacturing. EMS is also a very, very important subsegment of manufacturing, right? So, and capex and power. So in power, for example, there are many companies which are capex and, ancillary suppliers, equipment suppliers for power. So I think all of these are very, very important. One should be very careful when it becomes a buzzword. I think that you should be, because, by the time it reaches everybody's lips and tongue and radar, then
the valuations have gone crazy.
Careful. But yes, you are right. There will be times when things will become expensive, things will become cheap.
No, brilliant. Thank you so much. Moving on then, from a WhiteOak AMC perspective, what's your core investment philosophy? Is there anything that you stick by, or do you, depending on the market cycles, you vary?
So, Rahul, definitely we don't. So 2-3 things I'll tell you. One is that, we are, like I said, we are managing portfolios to beat the benchmark. Sure. We don't say things like, we don't take call on macro.
Right.
So I'll give you an example. Let's just take it on a lighter note. We all watch cricket. Now, when we watch cricket, nowadays people watch a lot of T20. So Rahul, you must have noticed that in every T20 match, if you look at the team composition, there are 5 to 6 batsmen, 2 to 3 all-rounders, maybe 3 or 4 specialist bowlers, and the wicketkeeper is always a good batsman, correct? Plus minus 1 in every category, right? But generally this is the composition. But Rahul, if you and me are forming a team and I invite you over to Mumbai and say that, okay, Rahul, this match is being played in 1K day, and we both are forming, selecting a team, we are entering the contest. So I tell you, Rahul, it's 1K day, that, 200 runs is par for course. So let's do one thing. tomorrow we'll win the toss, we'll elect to bat. Let's go with 9 batsmen. And we'll take batting and we'll hit 400.
Right.
Let's set the tone for the match, right? If we go like this, what do you think will happen, Rahul, tomorrow morning or tomorrow evening? What do you think will happen?
You may not hit 400. I think this is unrealistic in my view.
Yeah, so Rahul, what will happen is, first of all, we'll lose the toss.
Okay. That's a good starting point or bad starting point, whichever way.
Yeah. So what will happen is you'll lose the toss.
Right.
So the opposition will score 500.
Sure.
So if I make such a team and then I ask you, Rahul, what do you think will happen in the match tomorrow? So you should, basically your answer should be, Aashish, there is no match, there is only toss.
Right.
If you
Your
win
match
the
is
toss,
dependent. Exactly.
the toss will decide the match. Second thing is, can you judge the competency of a captain by determining whether he can win the toss or not? The last thing that the captain will practice is toss.
Even if he practices, it's not going to make any difference.
Not going to help. So the short point, obviously we're not sitting here to discuss cricket, however passionate we may be. The point I'm trying to make is that cricket teams are never made assuming that we win the toss.
Right.
Cricket teams are never made assuming that Wankhede will behave like Wankhede. Once in a while it may behave like Rajkot or Chennai or Mohali also.
Sure.
Right. And cricket teams are never made assuming that we will elect to bat and we will score 400. Our openers may fail also. Yeah, we never know, right? So cricket teams are made assuming you may win or lose the toss. The pitch may or may not behave. Your opening pair may or may not score. That's how you make the team. So same way, when we make our portfolio, we don't make any assumptions. When we make our portfolio, we are very clear we have to beat the benchmark.
Right.
Okay? Which means that, and like I already told you, that the benchmark has all types of companies. But when people enter the stock market, they enter with so many preconceived notions. Some people say, I will only buy growth stocks. Some people say, I will buy cheap. Below 2 price to book and below 20 PE multiple. I will not pay expensive. Then some people will say, I will buy PSUs. Some people will say, no chance. They have government interference. I will never buy PSUs. So see how many preconceived. Some people say, money will be made only in small caps. Right? Some people will say, you just can't make money in consumer companies. They are very expensive. Some people say, defense. So what is happening is, willy-nilly, everybody's portfolio, the best of portfolio managers or even a retail investor, unfortunately, everybody enters the market with a bias. And every bias is the equivalent of a preconceived notion that I am going to win the toss. When you make a portfolio of only small cap, when you make a portfolio only of data center or defense or healthcare, you have assumed that this is what will work. This is how the pitch will behave. You have assumed that I will win the toss and elect to bat. That is why for a lot of portfolio managers and for most retail investors, either their portfolio is beating the lights out of the market or they are nowhere near the market. They are down in the dumps. There is very wide range of outcomes. As a professional manager, we believe that our first job is to beat the index and second is to narrow down the range of outcomes. When I beat the index, I cannot be sometimes 20% ahead of the benchmark and sometimes 20% behind the benchmark, right? So what we do is that we make a portfolio which we call is a factor balanced and sector balanced portfolio. So if you look at our portfolio cursorily, you will find that on many places it is aligned with the benchmark, but it is 60% different from the benchmark. So for factors and sectors, if it is aligned with benchmark, but yet it is 60% different from benchmark, then you can imagine that the stocks are very different. Right. So if you find that IT exposure in my portfolio is plus minus of the benchmark, but still I'm beating the benchmark handsomely, means the stock composition is very, very different. So one of the core differentiation for WhiteOak is that we take portfolio construction as an extremely important scientific activity. And why I started with this is because whenever you ask someone what's your investment philosophy, they will only talk to you about stock picking. In our industry, all the folklore is about stock picking, right? If you bought Wipro in 1980, what would have happened? And you see Mr. Jhunjhunwala bought Titan, and you see Mr. Ramdev Agarwal bought Eicher Motors, etc. There's a lot of success stories related to stock picking. But normal individual retail investors, they don't have these success stories of multi-baggers as much. A normal person should be trying to beat the index by 3-4%. That is more than enough for them to really, stay in the game for long and change their outcomes. So we also focus a lot on stock picking. We have our own valuation models. We have our own investing, stock picking philosophy. But I think where we are significantly different at first is portfolio construction.
Right.
And then, of course, when we do stock picking, 2-3 things we do differently. One is that we don't go by stuff like PE multiples and price to book. Every company we value, we make a discounted cash flow of the company purely on free cash flow basis.
One childish question I have, because I'm a retail investor, I buy and sell my own stocks. I log into my Demat account and do whatever trade I need to do. How does that work for AMC businesses? Like you have a fund manager allocated to a fund, flexi cap or whatever.
Yes.
Do they themselves go and buy or sell stocks on the exchange, or how does that process work?
Okay, no, so it's not childish question. In fact, there could be many preconceived notions about what a fund manager does. So great that you asked. It's a good opportunity to clarify. See, fund managers actually, we don't expect and we don't want our fund managers to be doing buying and selling on the exchange. So, Rahul, when it comes to managing money, I would put it this way, that there are, say, 4 or 5 distinct roles. Okay. Let's talk in 4 parts. So one is the analysts. Second is the portfolio managers, right? Third is there are dealers. On your specific question, how do you do buying and selling? It is done by the dealers, dealers and traders, right? Then there is something called an investment committee.
Right.
Then there is compliance and risk. So, right, I've described to you 5 parts. Actually, somewhere investment committee, compliance and risk, they kind of dovetail.
Sure.
That's fine. So, analysts, portfolio managers, dealers and traders, investment committee, compliance and risk management. All of these are, so what do analysts do? Like say I said we have 34 analysts, we cover more than 1,000 companies. So they are obviously divided by sector. So these are analysts. Analysts are the guys who recommend to the portfolio manager that, okay, you're doing your portfolio construction to beat a particular benchmark. In this benchmark, these are the sector weights. So, obviously you have to have exposure to the sector which I am covering. So here are my recommendations for this sector.
Sure.
Moving on to the fund manager. The fund manager's job is, obviously they also meet companies because they also want first-hand understanding of why the analyst is saying what he or she is saying. So fund managers are also involved in research very heavily. But beyond that, fund managers are involved in constructing a portfolio. Because, you asked retail investors question. I want to say one thing. Every portfolio is a list of stocks. But any and every list of stocks that you come by cannot be called a portfolio. Because a list of stocks is a list of your favorite stocks. But a portfolio is a scientifically constructed basket to beat the benchmark, right? That's what we call a portfolio. So fund managers are tasked with constructing a portfolio. They are tasked with risk management, because if this is the benchmark and this is your portfolio, where are you operating? I mean, I hope you're not operating in a completely another playground, because then either you will beat the benchmark or you will go horribly wrong. We want outcomes. I told you right at the onset, we want outcomes in a reasonable range. Investors don't stay us only if we give high returns. Investors stay with us if we offer a consistent range. See, nobody wants, I don't know how to put it in English, but in Hindi you would say nobody wants kabhi Jannat, kabhi Jahannam wala experience.
Sure.
People want a reasonable range of outcomes. Then I can stay put. If you have very unpredictable behavior, then I cannot stay invested with you. So fund managers do all of that, risk management, portfolio construction. Right? Then it comes to dealing. So every day there may be money coming in, money going out. Sometimes you have to buy, sometimes you have to sell. Sometimes a stock has gone up a lot, you need to trim your position.
Sure.
Sometimes your hypothesis is not playing out, you need to sell a position. So every morning, and sometimes through the day 3-4 times, the fund managers relay instructions to our dealers. And that is also sophisticated. You cannot just send an email or make a phone call. There's a system in which these trades or these portfolio instructions are entered into a system which gets relayed to the trader and the dealer. And the dealer relays it onwards to brokers in the exchange or in the market. So it's because, dealers, it's a full day activity. We cannot expect fund managers to be doing that, because then all the other job they'll not be able to do.
Yeah.
When the market opens till the market closes, the dealer is in front of the screen. And when he receives an instruction from the fund manager to buy something or sell something, little bit he uses his own judgment, because he needs to see what is the price behavior, what is the volume, what are some of the technical indicators of how the price is likely to behave. So he will pace it out, what he has to do in terms of execution.
Right.
Investment committee reviews the performance periodically. There's compliance and risk management, which decides, sometimes you cannot have more exposure in this stock. Look at the liquidity in the market. You're already owning so much. How will you ever sell? So all of these are very important activities.
All right, let's move to then my favorite segment of this podcast, which is the rapid fire round. So Aashishji, I'm going to ask you 10 questions. I'll give you 2 choices.
Acha, good.
And you will have to, you can't think really too much, because I want to see what's your instant reaction to some of these questions, right?
Okay.
And if you don't want to answer anything for whatever reasons, right, it might create a controversy. I do understand that you work in a very tight regulatory environment. Yeah. So you could say that I prefer not to answer. Yeah, okay, absolutely fine. But I would like you to answer as much as possible.
Okay.
So with that, let's start with the first one. So when it comes to stock picking, do you trust your data or do you trust your instinct?
No, it has to be both.
You have to choose one.
Data.
Brilliant. Momentum or value investing? Preferred choice?
Value.
Okay, the third question I'm going to slightly change based on our conversation. So do you look at PE ratio, PB ratio, PEG ratio, or do you look at discounted cash flow?
Discounted cash flows only.
Indian stock market or US stock market? Preferred market for you?
Indian.
Any particular reason right now? I mean, you talked about the economic growth.
You forced it on me to select one. My actual view is that everybody should have some US exposure. But if I have to pick one, it will be India. And why I said everybody should have some US exposure is because US is the truly global market. I mean, it is the fountainhead of all innovation and all technology. Whether it is medical science, whether it is technology, whether it is financial services. In everything, US is the world leader.
Absolutely.
So if one market, then I would pick India, but I would not want a portfolio which does not have any US exposure.
Allocation. The reason I also wanted to check with you, since you touched upon US market, is the debt, US debt, right? And it's been talked about, and we know the facts are that they are in huge debt, right? Yeah. And of course, the confidence in the currency has been lost to a degree. Yeah. So would you get jittery about US debt because it's piling up?
See, at some point in some way, if you see, we have to see how it plays out, right? I mean, there has been a cycle where US has been on a roll for 12 to 15 years, and it's all been reverting. So maybe for a couple of years, maybe US will not do well. And obviously, currency depreciation is being done to probably allowed to get over the debt, right? They'll allow inflation to go up, and there is some force on the Fed to cut interest rates despite concerns on inflation. All of that, devaluation, inflation, all of that is being brought about in order to reduce the debt burden. Right. Putting tariffs, slowing the economy, collecting more revenue. Everything that the US government is doing is to reduce their debt and pass on some of their burden to the trading partners. Right? So we have to see how it plays out. But till the time they are the world's biggest military superpower, the world's biggest education superpower, technology superpower, all kinds of R&D, and truly global. So I wouldn't get overly bearish on US. Maybe I would be just careful for the next couple of years and see how it plays.
Sure. Brilliant. No, thank you for that. Moving on, next one, Nifty or Sensex, which is your favorite index if you have to choose one?
I track Nifty actually.
Nifty, okay. Any particular reason or?
It's just habit. Habit actually.
Nothing about Nifty has got 50, so Sensex got 30
stocks. Yeah, there will be. Maybe that is why it's developed over a period of time.
Sure,
that it's more widely tracked. But instinctively I just track Nifty. Sure. And I remember more about Nifty numbers.
Bitcoin, a hype or future currency?
No, it's not a hype for sure. One has to study it.
Sure. Okay, this might be a little controversial, and you can say no to it. Mr. Trump, good for India or good for Pakistan?
No, it's good for India.
Good for India, okay. Yeah, I just want to hear more about that.
No, he's just obviously he's a businessman and he's just a very in-your-face negotiator.
Right.
But obviously he's a businessman, he's brilliant, he knows what he's doing. Maybe you may not like his negotiating tactics or you may not like how he is conducting it. But everything he's doing it for US first.
Right.
And obviously, India is a more important and a more salient economy. So sometimes his negotiating tactics are too in the face or too, blatant.
Right.
But we have to read through it. So whatever my understanding, I don't think he's bad for India. I think he's just trying to prioritize his own country and negotiate.
Brilliant. Okay. Next one, gold, physical or digital?
For investing, it should be digital. Yeah, digital.
Ambani's or Adani's better leaders?
That is actually very, very difficult. But till now, whatever I have learned, growth is life, is the most salient, is as good as one of my beliefs. So I relate to it more.
Right. Cool. Best time to make money in stock market, is it bull run or bear run?
Bear run. The bull run only makes your account statement look good. But the account statement looks good in the bull run purely depending on how well you behaved in the bear run. So bull run, your account statement looks good in the bull run because you invest in the bear run. So money is always made in bear markets. Bull market only shows the manifestation in your account statement.
Sure. Absolutely agree. Fantastic. You did really well in answering all the 10 questions. So thank you so much. Any last words from you, Aashish, before we say goodbye to our audience?
No, I think, I'll just repeat once what I said in the beginning that, 2030, 2031, by when the market will double, all of that is less important. I think staying the course and being there when it happens is more important. So, be consistent, be disciplined, don't take risks which you can't handle, and make sure you never get thrown out of the game.
Brilliant. Guys, that's very, very good advice, that stay invested. Do not track market almost on a daily basis. We all dragged into market, typically when the market is falling or why the market is falling. I think the word of the wisdom that I am taking from this wonderful conversation is that you got to think long term, manage our risks properly, and do not venture into the areas that we don't understand, right? So thank you so much, Aashish ji.
Thank you, Rahul.
My pleasure to host you, and I look forward to have you again sometime
Thank you.
in future
My pleasure.
as well.
Thank you.